The stock market has really pulled back in 2025. At one point, the NASDAQ 100 was down over 20% from its all-time high. The S&P 500 has almost hit that 20% number. That would be typically considered a bear market territory. And I think now is a great time to think about what are the stocks that you want to buy opportunistically if the market continues to fall over the next few months, or maybe potentially even over the next few years. Remember, market declines that are driven by recessions, which we may already be in a recession in the US, those don't typically last a few weeks or a few months. Those typically last a year or two. Between the market's peak in 2000, the market didn't bottom until 2002. Market peaked in 2007. Market didn't bottom until March of 2009. Those were traditional recessions. COVID, there was absolutely nothing normal about that. So I don't think there's a lot we can learn about that for 2025's market. But if we did hit a peak in January and it's downhill from here over the next few months or even the next year or two, what stocks do I have on my watch list that I don't own yet, but I would love to buy if I can get them at the right price? I'm going to go through 5 of those here today. I also have them timestamped below. So if you want to skip forward to a stock that you're interested in or that you want my thoughts on, feel free to skip forward. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Subscribe here on YouTube for all my content, but also check out my newsletter, Asymmetric Investing. There's a link on the screen and a link in the show notes. That's where you can get all my deep dives, more market thoughts, and of course, my asymmetric investing portfolio. That portfolio beat the market by a wide margin in 2024. So far, it's still beating it in 2025. And I'm going to be an opportunistic buyer and even increase my purchases if the market slide continues. So check that out. And I also want to point out that everything I'm showing here today is going to come from FinChat. FinChat is the best fundamental research tool that's out there. They have information on over 100,000 stocks globally. Everything you need from multiples to financials, SEC filings, investor relations, presentations, transcripts, it's all in one place. But the best thing about FinChat is their KPIs, or key performance indicators. This is where you can simply look up the most important indicators for a company and see what those trends are. You can chart them over time. You can look at the last decade. You can look at trailing 12-month numbers. I'm going to do that here today. If you want to try this out for yourself, go to finchat.io/ASYM. You're going to get 2 weeks of Pro, which is what I'm going to show here today, for free. And if you like what you get there, you get 15% off at that link. So check that out, and let's dive into FinChat with NVIDIA. NVIDIA is a stock that I have never owned. Definitely missed this one over the past few years. But NVIDIA today is not the company that was 2 or 3 years ago. This is now primarily an AI data center company. The fundamentals of the business are very different than they were, but it's still a very, very highly valued company. If we just look at the basic valuation numbers, 36.6 PE multiple. On a forward basis, this looks a little bit more reasonable. PE is 23.8, but you can see that the stock just year to date is down 20%. So why is it down 20%? Well, there's a couple of reasons. The first reason is that the growth rate is slowing. The company is not shrinking, but the rate of growth went from negative in April 2023 all the way up to over 200%. And these are all trailing 12-month numbers. That growth rate has fallen to 114% over the past year. Still phenomenal growth rate. The question is, how much is that going to slow in 2025, in 2026? There's getting to be more competition in the AI space and in the chip space. Doesn't mean that NVIDIA is going to lose its leadership position, but it does mean that that growth rate may slow significantly. So that's a question that investors have. The other thing I'll pull in here, and I'll take the growth rate away, but this is their margins. And you can see that margins soar. These are margins that we've never seen. If you just look at the annualized numbers, NVIDIA typically has a gross margin 50, 60%. Their operating margin typically, in the high teens, maybe up to 30%. But right now, their operating margin is 62% in the past year, and their gross margin is 75%. They have a ton of pricing power, and they're leaning into that pricing power with their AI chips. So that has been a huge driver of the bottom line improvement. This is their net income. You can see that that is a massive hockey stick because you have margin expansion and phenomenal growth at the exact same time. It's kind of like a perfect storm for NVIDIA. So unquestionably, this is a phenomenal company, but I want to get it at a no-brainer price. I want to be greedy here. I want to be at a PE multiple of under 20. That may sound crazy today, but remember in 2014, 2015, you could buy shares of Apple and Microsoft at 10, 11, 12 times earnings. These were phenomenal companies. They were still growing. They're extremely profitable. And you could get them for very, very low multiples because the market undervalued those companies. You go back to the Great Recession and the deals were even better. So again, if we go through a market downturn where everything is sold off, where risk is the thing that investors are thinking about, NVIDIA is a stock that I want to buy, but I don't want to buy it at $110 per share. I want to get it at $50 per share. Are we going to get there? I don't know if we ever will. But if we do, this is a stock that I would love to add to the portfolio. Another one that falls into that same category is Palantir. You can see Palantir a couple of years ago trading for $7 per share. We're now at $88 per share. But the multiples for Palantir are kind of insane. Enterprise value to sales is 71 right now. This is a growth company, but it's not an extremely high growth company. I'll get to those numbers in just a second, but this multiple is just crazy. If it was trading for 7 times sales, that would be a much better deal, much more compelling price. Again, I want to buy shares of Palantir, but I don't want to overpay for shares of Palantir. Could the stock fall 90%? Plenty of stocks that were extremely highly valued in 2021 dropped over the next couple of years, and that's when investors could pounce on those opportunities. Why don't I want to overpay for Palantir? Well, this is some of the same numbers that we looked at earlier with NVIDIA. The black column is total revenue. So you can see that revenue is growing, but the compound annual growth rate since 2022, at the start of 2022, is only 22%. Now that growth rate has picked up. This blue line is showing the growth rate, and these are trailing 12-month numbers. So as this number picks up and moves higher, that's why the multiple has expanded over the past couple of years. Investors don't like slowing growth. They like accelerating growth, but that's why you're paying for growth that hasn't yet hit the income statement yet. You can see that margins are also expanding. Net income, $462 million over the past year, but $462 million for a company that has a $208 billion market cap. That is a very, very high price to pay. So again, if Palantir gets to the point where it's trading under $20 per share, I'd be interested. If it's trading under $10 per share, I'd be extremely interested. But today, I don't want to take the risk on buying a company that's trading for 70 times sales. That's not an asymmetric opportunity from here. But again, in a market pullback, this is where high growth stocks like this are going to be thrown out along with everything else. And that's when you're going to get real opportunities in the market. Another phenomenal company that I've never owned, Meta Platforms. Right now, $1.4 trillion market cap. Not the most expensive stock, trading for 23 times earnings right now, 22 times earnings on a forward basis. Reasonable multiple to pay for this company. I'm not looking for the same drop that I may be looking for with NVIDIA or Palantir. But if shares of Meta Platforms are trading for under 14, 15 times earnings or free cash flow, that's when things get really compelling for me. That's about $350, $400 per share. Again, if the market sells off, if we go into some sort of a recession, if their growth rate goes negative, which remember it did in 2022, negative 1.1% growth rate, that's when you're going to get a much better deal on a stock like Meta Platforms. But the company has proven that this is a phenomenal compounding business over the long term. I just want to get it at a better price. That's the bottom line. But after questioning this company and the durability of the social media platforms and the decisions that Mark Zuckerberg is making, particularly around things like the metaverse, I think Meta Platforms is a much more mature and better company today. If you get it at the right price, I think there's a phenomenal opportunity. Number 4 is another one that the market has started to throw out. I'm going to just show the drawdown here. This is a 64% drawdown. This is just since December 2024. That was when the stock peaked. But you now have $24.5 billion market cap for a leading company in the digital advertising space. Just look at the fundamentals. Now, this doesn't include the challenges that they've had with some of their newer products and some of the reasons that the stock is down, but just look on the trailing basis, how much this company has compounded revenue and net income over the past decade. You can see the compound annual growth rate, 41%, net income compound annual growth rate, 43%. Not a lot of companies are going to give you that kind of performance. And right now you're getting it for enterprise value to sales of 9.4. Maybe not a no-brainer buy at this price, but not super expensive. So again, this is one that is on my watch list and is getting much, much closer to the point where I potentially want to buy it. $50 per share. If the market drops, if we can get this for $30, $25 per share, that would be a phenomenal value, I think, because the digital advertising space is only growing. Trade Desk has a number of really phenomenal partnerships with companies like Spotify and Disney. There's going to be tailwinds behind their business, potentially for the next couple of decades. These short-term dislocations, which you see over the past few months, are often long-term buying opportunities because companies will evolve and adapt to all the things that the market is questioning right now. And if we get a further market pullback and that pulls down a stock like the Trade Desk, that would be an even better buying opportunity. Finally, Rocket Lab. Rocket Lab is much more speculative than these other companies. There's not a great business there. I'll get to those numbers in just a second. But we have a $9 billion market cap, enterprise value to sales. And this is a growth company still in kind of the development phase, but it's 20 times sales. So I just don't see as much upside as we had, when shares were trading at $3, $4, $5 per share. But this is a much more mature business than it was at that period of time. So let's pull up revenue and then let's also do free cash flow. And if you look at all these trailing 12-month numbers, we have great revenue growth. That is exactly what you would expect to see from Rocket Lab, but you're still burning a lot of cash. And that's really the risk, is that you're paying a lot for a company you're just projecting future cash flow. But let's look at a couple of their KPIs. First of all, their launch backlog and then their space systems backlog. And we can stack those together. This is what I think is ultimately the most compelling, is that this number is going to continue to grow as they sign more contracts for more launches in the future. I do think they're eventually going to get to better gross and operating margins. especially as you use these rockets and you learn more over time. Again, if I get this for a no-brainer price where the upside is asymmetric, that's what I want to get from Rocket Lab. So if there is a market pullback, this is one of those higher risk companies that could potentially fall significantly. And that's when I want to be opportunistically buying a company like Rocket Lab. The 5 stocks that I would love to add in a market pullback, I think all asymmetric potential businesses if you get them at the right price. Those are NVIDIA, Palantir, Meta Platforms, The Trade Desk, and Rocket Labs. Which one of those is your favorite, and what price are you looking to potentially back the truck up if we get some sort of market pullback or recession that hits over the next year or two? Let me know in the comment section below. Don't forget to subscribe to Asymmetric Investing, my newsletter as well. And hopefully you got some value from seeing some of what you can do with FinChat. Again, you're going to see their charts on my newsletter and in all of my videos. And you can use this yourself at finchat.io/ASYM. Thanks for watching, everybody. We'll see you here next time.